When most people are starting out in the stock market and starting to get their feet wet, they think that they need to take all the money that they've saved up or whatever amount that they're going to risk in the stock market and go all in on an idea. And that leverage is what's going to allow them to have this big upside. So if I have a lot of conviction in this stock, then I should go all in, and then if that stock goes up 50, 100%, then I've doubled my money, and that's great. But what happens if that stock falls? Where are we going to get out? The way that we can manage risk is in really two different ways. There is a pyramiding strategy, and then there's another strategy that I like to call reverse engineering, or backing into the number of shares that you can buy and still risk only this much. So let's talk about pyramiding first. The pyramiding strategy is simply dividing your portfolio into separate tranches. Let's say that you want to risk or you want to have 5 different stocks in your portfolio and you have a $10,000 portfolio. Okay, so first we are going to have $2,000 positions for each one of those. Then the way that we're going to pyramid is to first buy a stock at a certain price, wherever we feel as though it's going to break out, or whatever strategy we're following. Then as that trade begins to work, then we are buying the rest of our position. So we'll buy half of it first, then buy another 30% as it continues to work, and then buy the last 20% as it continues to work. And so the idea behind that is that the market is telling us that our idea is working, and as it's working, we are continuing to feed that strategy. The problem that I've experienced with that strategy is that often a stock will work at first, and then it will roll over and break each of those potential selling points that I would have had. So like if I had set a stop loss at 7%, it will roll over and trip 7% from each of those 3 buys. And then I end up losing even more money than I had originally intended. So that's a strategy that works for some people, did not work for me. The way that I like to position size and the way that I've learned how to do it to make it work is this reverse engineering strategy. So here's how I back into the number of shares that I could buy. First, I go to ChartYourTrade and I pop open our position size calculator. The calculator's there, it's for free, just go to the site and you could follow along too. So I come over here, click on Tools, open up the position size calculator. And so let's say we have that $10,000 account, right? So we type in $10,000, and then we're going to figure out what percentage of our $10,000 do we want to risk on any one trade. For me, I only like to risk 1% of my capital on any trade. So if I buy a stock and that idea doesn't work out, then I'm only going to risk $100, and I'm only going to be out $100. But that doesn't mean that I'm only buying $100 worth of stock. That means that I'm only risking $100. So here's what I mean. So we're going to risk that 1%. Let's say that we're buying a $50 stock, and let's say where our initial stop is going to be, let's say we plan to exit if that stock falls to, say, $45, right? So we're risking 10% on that idea. So here's where it gets interesting, right? So based on what we input, we're able to buy 20 shares, and we are going to risk just $100, right? The difference between that 50 and 45 multiplied by 20 is $100 of risk. Our actual position size, so the size of our position is $1,000. So we're taking 1,000 and we are putting it into this stock and buying that 20 shares. And so the difference between the entry point and the exit point is 10%. So between $50 an hour, exit at 45, that's 10%. Now, here is how we can leverage our position. So let's say we're getting in at $50, but let's say that it actually makes sense to exit if the stock falls below $48. Let's say that there's a major support level there. Let's say that maybe that's the 50-day moving average. Maybe that's the 200-day moving average. Maybe there is support that is built at that level for 6 to 8 months, right? So putting in that, so $48, now all of a sudden we're able to buy 50 shares of this stock. And now our position size is $2,500, or 25% of our $10,000 that we started out with. And if you look down here, we're still only risking that same $100. This is why I prefer to use this reverse engineering or backing into the position style of risk management. I'm always going to risk the same amount no matter what the trade is, and the size of my position can vary, and I'm able to also strategize by finding the entry point and exit points that are closest together, that make the most sense on the chart, and just focus on those, so that way, rather than going for trades that are potential 3-to-1 reward to risk, I could go for trades that could be a potential 5-to-1 or 6-to-1 based on what the chart looks like. And if I'm only going to end up getting a 3-to-1 reward to risk, it's much easier for a stock to go up in this particular trade. If it was going to be 3-to-1, we're looking at a 12% gain, right? So much easier for a stock to go up 12% in most cases, everything else held equal, than it will be for it to go up 30%. So this is a way that you're able to maximize your potential reward while minimizing your potential risk. Thank you so much for watching. I truly, truly appreciate it. If you have any questions at all, again, leave that down in the comment section below and I will personally help you. If you like this video, click that thumbs up button. That's always going to help us out a lot. And make sure that you subscribe to the channel so that way you get every single update. Thanks again for watching, and I'll see you again in the next video. Take care and have a great day.